Welcome back, everyone, to the Psychology of Money podcast. Thanks so much for joining us again. Pull up a chair, get comfortable. Think of this as our sort of intellectual living room.
Great to have you with us.
Because today we are tackling, well, probably the single most debated, maybe confusing, but potentially transformative idea shaking up finance right now in 2025.
Yeah, we're moving past the crypto basics, aren't we?
Right.
We're getting into what the industry is calling RWA, real-world asset tokenization.
RWA tokenization.
Essentially, it's taking the ownership rights for real traditional stuff, office buildings, funds, bonds, even private credit, and turning them into digital tokens.
Tokens on a blockchain.
Exactly. Transferable. Digital tokens on a blockchain.
Right, and the headlines, I mean, they're screaming revolution, aren't they? This is the next big thing for crypto. Efficiency, liquidity, markets open 204/7.
All the good stuff.
But for us, looking through that psychology lens, we have to ask the big question, is this really about better tech, or is it? Well, is it just the same old human drama playing out on a new stage?
That's exactly it. That's the core question for today, I think. Because if you strip away all the fancy tech talk, the DLT, the smart contracts, what's driving this?
What is driving it?
It's two very old, very human things, isn't it? One, that deep-seated desire we all have for wealth, for ownership. And two, that intense gut-wrenching fear of missing out. FOMO.
Oh, FOMO. We know that feeling. Pressing your nose against the glass, right? Watching a party you weren't invited to. You see someone tweeting about fractionalizing some art piece or a private fund, and suddenly your sensible index fund feels, well, boring. Hopelessly slow.
That feeling, that pressure, that's what we need to unpack.
So that's our mission for this deep dive, baked right into the title. Is this 2025 tokenization hype a real fundamental shift in how we think about assets, driven by actual utility?
Or are we just running the same old psychological playbook, the bubble playbook, just get dressed up in shiny new digital clothes?
Right. Okay, let's ground this first, because the core idea of splitting up ownership, it's not actually new, is it?
Not at all. Let's think way back. Like a medieval mill.
A medieval mill.
Yeah, think about it. In a village, the mill was crucial.
Yeah.
Super expensive, couldn't really divide it up easily, but everyone needed it.
So how do they fund it?
Well, the community chipped in. They created these simple ownership shares, maybe just carved tokens, tally sticks, something like that. Transferable. That was like proto-tokenization.
And the driver there was?
Pure utility. Survival, really. And trust within the community, not speculation.
Okay, fast forward a few centuries, 17th century.
Exactly. The Dutch East India Company, they needed massive capital for those risky voyages.
So they took that mill idea and scaled it way up.
Precisely. They divided the ownership of the whole huge company into paper shares action, sold them to the public. World's first stock exchange, right there in Amsterdam.
Democratization of investment on a big scale.
Absolutely. But here's the crucial psychological twist. The second those paper tokens started trading, their price began to detach.
Detach from what? The actual ships and spices.
Yeah, detach from the underlying value. People weren't just buying a slice of the profits anymore. They were buying the story, the dream, exotic lands, massive riches.
The narrative became the asset.
For a while, yeah. The story got more valuable than the actual stuff, and that detachment. That's the birth of the speculative bubble, psychologically speaking.
That really sets the stage for today, doesn't it? Is tokenization the rational, useful mill, or is it the exciting, narrative-driven Dutch East India Company shares?
That's the debate. Let's start with the case for rationality, the institutional shift. What do the numbers say?
Okay, yeah, the 2025 Institutional Investor Digital Assets Survey. The sources lean on this heavily.
And it's compelling stuff, right? Because it suggests this isn't just fringe retail hype anymore. The market seems to be maturing structurally.
Let's get into those numbers. They're pretty eye-popping. 86% of the institutions surveyed, we're talking big players, pensions, hedge funds. 86% either already have skin in the game or plan to allocate in 2025.
86%.
Yeah.
That's significant buy-in. It's not a niche experiment anymore.
And it's not just pocket change, is it? 59% plan to put over 5% of their total assets under management into crypto and related stuff.
Over 5%.
Yeah.
Yeah, and U.S. funds and hedge funds are apparently aiming even higher. That tells you they're not just testing the waters. This looks like a strategic shift, long term.
And crucially, for our debate, what's their focus? Is it just riding the Bitcoin wave?
Not primarily. According to this, 76% of these firms plan to invest in tokenized assets specifically by 2026.
Okay, so RWA is definitely on their radar. And the reason they
Portfolio diversification, that's the main driver cited. They're looking for assets that don't just move with the stock market, and they're looking for better operational efficiency. It seems utility-driven.
Where are they focusing that utility drive? Stablecoins seem big.
Huge. 84% are using them, are interested. But again, it's not about the stablecoin price going up. It's about, well, convenience.
Transactional convenience.
Yeah, and yield generation, and especially foreign exchange efficiency. FX. Think about moving money internally. 68% are using stablecoins for internal cash management.
Why? What's the advantage over, say, a wire transfer?
Speed and cost. Stablecoins move 24/7. Settlement is almost instant. Compare that to traditional systems, days of waiting, fees, manual checks. Stablecoins are like cheap, fast, on-chain dollars.
So it's like better plumbing for finance, using blockchain for faster internal money movement, settling securities trades. 61% interested in that.
It's a massive efficiency gain.
Yeah.
And it doesn't stop there. Look at DeFi, decentralized finance.
Right. Institutional engagement there is set to, what, triple?
Nearly triple in 2 years, from 24% now to 75% planning engagement. And they're looking at core financial stuff. Staking for yield, 38%, lending, 34%, derivatives, 40%. Practical applications ported onto the blockchain.
It feels like they're using this tech to fix problems that have existed for ages in traditional finance, like the U.S. Treasury market.
Perfect example, $28 trillion market, the bedrock of global finance. And technologically, it's kind of ancient history.
What are the specific problems DLT is trying to solve there?
3 big ones. First, settlement delays. T+1, T+2. That ties up huge amounts of capital, creates risk. Second, too many middlemen. Layers of intermediaries taking cuts. Third, access isn't always smooth.
Let's focus on those middlemen. How does tokenization actually cut them out? What's the mechanism?
Okay, so traditionally you trade, then you match, then clear, then settle. Lots of steps, lots of players, brokers, clearing banks, custodians. Each adds time, cost, and potential failure points.
Right.
DLT, with a smart contract, aims to collapse that. The trade and settlement can happen almost simultaneously on the ledger. But the smart contract basically is the settlement agent, cutting out many intermediaries.
Fewer steps, lower fees, less risk of someone dropping the ball between trade and settlement.
That's the promise. And importantly, lower systemic risk because you're not waiting days for things to finalize.
And this isn't just theory anymore, right? We have examples like the Janus Henderson Fund.
Exactly. The Janus Henderson Anemoy Treasury Fund. It's running on Centrifuge, offering tokenized U.S. treasuries to institutions, real-world utility.
And the benefit is
near instant liquidity. No T+2 wait. They can redeem up to $125 million, 247, even on a Sunday.
wow. Being able to move that kind of capital, instantly reducing risk, that makes the rational case pretty strong. It's the medieval mill, but digital and global.
That's the institutional efficiency argument.
Uh-huh.
But there's a potential stumbling block here, isn't there? Even with this efficiency, this idea of siloization.
Right. So the tokenized treasuries are great, but they might exist in their own little world.
Potentially, yeah.
Mm-hmm.
Early applications often focus on optimizing one specific thing, one vertical, like bonds. But the system isn't fully interconnected yet.
So the efficiency gained in bonds doesn't automatically flow over to, say, tokenized private credit or stocks. They're in separate silos.
That's the risk. Finance thrives on everything connecting. If tokenization just creates lots of super efficient but separate silos, we miss out on the big network effects.
What kind of network effect?
Being able to use any tokenized asset as collateral anywhere, instantly. Settling different types of assets against each other seamlessly.
Mm-hmm.
Using tokenized cash in any DeFi protocol. True interoperability.
That sounds like a huge integration challenge, beyond just the tech for one asset class.
It is. It requires cooperation, standards, getting everything to talk the same language. That might be a bigger hurdle than just optimizing one piece.
Okay, technology and interoperability aside, what's the other big piece institutions need? Regulation. They cite that as the #1 catalyst, right?
Absolutely. They need legal certainty. They need to know the rules of the road. And we're seeing regulators stepping up. People like IFSCA are actively building frameworks for RWAs, funds, bonds, stocks.
And the guiding principle seems to be same risk, same regulation, treating digital securities like, well, securities.
That's the baseline. But they also know DLT brings new kinds of risk, things traditional rules didn't anticipate.
What are those main DLT-specific risks regulators are worried about?
The sources highlight 3 main areas. First, governance. Who's actually responsible in these decentralized systems? If a smart contract messes up, who fixes it? Who's liable? The lines can get blurry.
Okay, governance. What else?
Second, legal certainty. How does contract law apply when the contract is just code executing automatically? Can courts enforce these smart contracts effectively, the legal system is still catching up.
Makes sense. And the third?
The classic one, money laundering and terrorist financing, MLTF risks, the speed, the global nature, the potential anonymity. Regulators are very focused on making sure this tech isn't exploited for illicit finance.
Okay, so that rounds out the rational case. Institutions chasing efficiency, diversification, using DLT for real cost savings, all hopefully within clearer regulations. Sounds pretty solid. Structural.
Does sound solid, but, and this is the big but for our discussion, has better technology or clearer rules ever stopped human irrationality in finance?
Historically? No, not really.
Exactly. The history of finance is the history of bubbles. The tech just provides a new venue. So now we absolutely have to pivot to that other side, the psychology, the ancient script that this tokenization hype seems to be running on.
Let's start with the big one, herd behavior. We hear that term a lot. For someone watching this market, how do we separate just, following a smart trend from actual irrational herding?
Good question. Herding is when you basically throw out your own homework. You ignore the fundamentals, your own analysis, maybe even your gut feeling, and you just copy what everyone else is doing.
Why? Just fear of being wrong or missing out?
Both. It's powerful social pressure. You stop asking, is this thing actually worth the price? And you start thinking, well, everyone else is buying. Maybe they know something I don't. I better get in too.
And the crypto market seems particularly prone to this. The data is pretty stark.
It's not just a feeling. It's quantified. We know Bitcoin is volatile, right? 3.3 times more volatile than the S&P 500, 4.6 times more than gold. Okay, fine.
But the herding part,
that's where it gets wild. Studies measuring that specific bias, the tendency to ignore info and just follow the crowd, found Bitcoin's herding bias is over 26 times higher than the global average.
26 times.
And 10 times higher than the S&P 500.
Wow. Okay, so that's not just a bit more volatile. That's an environment practically built for psychological contagion.
Precisely. And tokenization, even the RWA kind, with real assets backing it, is still happening within that psychological environment. It inherits that risk.
So what specific cognitive biases are fueling this, making history repeat? You mentioned the narrative fallacy.
Yes. Our brains love a good story much more than dry data. And the tokenization narrative. It's a great story.
How so? What makes it so compelling?
Hits all the right notes. Revolution, democratization, exclusivity. Think about the visuals. Own a piece of a Picasso, or get access to private equity deals only billionaires could touch before. It's exciting. It feels empowering.
Compared to buy and hold a low-cost index fund.
Exactly. Which is, statistically the wiser path for most people, but it's boring. Nobody makes viral TikToks about their index fund allocation.
Yeah.
Tokenization stories, especially the RWA ones promising access, are tailor-made for social media hype.
And that powerful story feeds right into the next bias, overconfidence, excessive optimism.
The classic bubble ingredient. The belief that because the tech is new and revolutionary, prices can only go up forever. We saw it in the South Sea bubble shares, soaring based on pure hype. We saw it in the dot-com bubble, investing in companies with no profits, no proven model, just internet optimism.
And we're seeing echoes of that now. Belief in the tech overshadowing actual current value.
It certainly feels like in some corners of the market. The potential of tokenization is used to justify prices that the current utility doesn't necessarily support.
Then there's the availability heuristic. How does the digital age make that worse?
Oh, it cocoa charges it. The availability heuristic is just our tendency to judge how likely something is based on how easily we remember examples.
And what examples are easy to remember online?
The viral ones. The stories plastered everywhere of someone getting rich quick off some coin, some NFT, some early token. Those stick in your mind.
But those are the outliers, right? What about all the people who lose?
Exactly. The far, far more common stories of people losing their savings, buying the top. Those are quiet. They're hidden. People are embarrassed. So our mental database gets skewed. We dramatically overestimate the chance of huge success and underestimate the chance of failure.
It creates a warped perception of the actual risk involved.
Massively warped. And finally, there's a subtle one. Unit bias.
Unit bias? What's that?
It's this funny little quirk where we like owning whole things or large numbers of things. Owning, say, 10,000 real estate tokens just feels more substantial, more powerful than owning 0.03 shares of a really expensive traditional stock.
Even if the dollar value is the same or less?
Even then. Token platforms often use this. They issue tokens with tiny values, so you can own millions of them. It makes small retail investors feel like big shots, like whales. It's a bit of psychological gamification.
Okay, this mix of biases, it explains a lot. But it leads us to the extreme end, doesn't it? Meme coins, where value seems completely detached from, well, anything real.
Absolutely. The rise of platforms like Pump.Fun really lays it bare. These coins have value based only on hype, mimetic popularity, collective belief. There's no underlying asset, no cash flow, nothing.
The sources call it the greater fool theory in action.
Textbook, greater fool theory. The only way to profit is to sell it to someone else, a greater fool, who believes the hype more than you do. It's pure momentum trading based on social media buzz.
And the structure itself seems designed for quick transfers of wealth.
Often, yes. The tokenomics rely entirely on new money constantly flowing in. Early buyers, often insiders or people with fast trading bots, make huge returns quickly. Later buyers are left holding the bag. It has characteristics that are worryingly similar to Ponzi schemes.
And there's a deeper, darker psychological element mentioned too, financial nihilism.
Yeah, that's a really interesting point. It seems particularly appealing to younger people who feel locked out of traditional wealth building. House prices are insane, wages stagnant. They see the traditional system as rigged.
So they turn to these meme coins as
a lottery ticket, high-stakes gambling. They're not investing based on fundamentals. They're gambling on cultural relevance, trying to time the hype cycle. It's less about belief, more about cynicism and a desire for a quick win, even knowing the risks are huge.
Okay, so we have this stark contrast. Rational institutions building plumbing on one side.
And this wild, emotional, speculation-fueled retail behavior on the other.
How do these two worlds collide in the RWA market? What happens when you try to tokenize real assets in that environment?
That's where the dual nature really bites. The promise is democratization, fractional ownership, lower barriers. Fantastic.
Ah.
But the ease of creating these tokens, combined with that intense herding behavior we talked about, it creates a perfect storm for exploitation.
Democratization sounds good, but without guardrails, it helps the insiders more.
It can become an insider's game, yeah. Because it's so easy to launch a token. Sophisticated players with better tech, faster bots, more information they can jump in, manipulate sentiment, front-run retail trades, and extract value. The playing field isn't level.
So the very tech-enabling democratization also enables faster, more efficient exploitation if you're not careful.
That's the paradox.
Yeah.
And the other big risk is contagion, because the crypto market is so interconnected.
Meaning, even if my RWA token is backed by something solid like a building, it can still get dragged down by a Bitcoin crash.
Absolutely. Bubbles in the big coins, BTC, ETH, they dictate the overall mood, the liquidity, the risk appetite for the entire ecosystem. When they crash, liquidity dries up everywhere. People sell everything, including the supposedly stable RWA tokens, just to get cash or reduce risk.
So the underlying asset value might be stable, but the token's price can still be volatile because of market-wide panic?
Exactly. We've seen hints of this. Studies show some DeFi assets, which might underpin RWA functions, having bubble periods lasting nearly 2 months. The instability in the broader crypto market inevitably impacts the RWAs built on top of it.
This really comes through when you look at that retail versus utility divide, what people say versus what they buy.
Right. If it was all rational utility, you'd expect everyone piling into the safest, most useful things, like physically backed commodity tokens.
Like tokenized gold.
Yeah, like PAXG. It's backed by real gold, redeemable, stable store of value. Perfect utility case, right?
So demand for that soared during the crypto recovery?
Actually, the opposite. Its total value locked declined almost 30% while money flowed into Bitcoin and Ether. People moved away from stable utility towards speculation.
Wow. And what about synthetic tokens? The ones that just track prices without holding the asset?
That's even more telling. At their peak hype in 2021, synthetic tokens tracking stocks or commodities had something like 300 times more capital locked in them than the current regulated asset-backed tokenized stocks.
300 times more demand for the purely speculative, riskier version.
It screams behavioral preference, doesn't it? Retail, broadly speaking, was chasing the hype. The volatility, not the boring, stable utility. Often running into regulatory walls, too, like with Binance stock tokens or Mirror Protocol.
Okay, so we have this messy reality. Rational tech, irrational humans. For the listener trying to navigate this, what's the psychological defense? How do you separate the signal from the noise?
The best defense is something institutions use themselves to manage their own biases. discipline. Specifically, strategies that take emotion out of the equation.
Like dollar cost averaging, DCA.
Exactly. DCA is powerful because it defeats FOMO and panic selling. You invest a fixed amount at regular intervals, regardless of price.
Why is that so effective psychologically?
Because it stops you from trying to time the market perfectly. You don't have the pressure of picking the absolute bottom or selling the exact top. You just buy consistently. It smooths out the bumps, forces a long-term perspective, and prevents those impulsive, emotion-driven trades.
Okay, disciplined timing is one thing. What about evaluating the actual asset? How do you look past the sexy narrative?
You have to become a narrative detective. Really scrutinize the white paper, the pitch. Look for those red flags we talked about. Is the value proposition based on real utility, real cash flows from the underlying asset? Or is it all about hype, new users joining, and the token price going up?
What are specific red flags for narrative over value?
Look for yield that seems too good to be true and isn't clearly tied to the RWA's actual performance. Yield that relies only on more people buying the token is a big one that smells like Ponzi-like dynamics. Overly complex governance that makes it hard to see who benefits first. Promises of guaranteed returns, focus on the boring stuff. How does this token actually connect to the real-world asset and its value generation?
And since so much of this is driven by online chatter, what about managing our information intake?
Crucial. You have to actively, aggressively curate your information diet, mute the hype merchants, unfollow the finfluencers flashing Lambos and promising 100x returns tomorrow. Their job is to create urgency and volume, not provide sound advice.
Who should you listen to instead?
Seek out the boring people, the credentialed experts, the experienced investors who talk about long-term strategy, diversification, risk management, people who acknowledge uncertainty. Honestly, understanding your own biases, your susceptibility to FOMO, narrative overconfidence, that's your most powerful tool. It's the real defense.
That brings us full circle, really. So to synthesize, tokenization. Yes, it's a real technological shift. It offers real efficiencies, lower costs, fractional ownership, 247 access. Institutions see that rational utility and they're moving in.
Definitely. That's the logical driver. However, the way it's being adopted, especially by retail and in the riskier corners of the market, it's absolutely drenched in that timeless bubble psychology. Herding, FOMO, narrative over substance. The tech is new, but the human behavior.
Ancient.
The stage changes, the play remains the same.
Pretty much. Okay, before we wrap up, here's a final thought for you, our listener, to chew on. We mentioned that siloization challenge for institutions.
Right, the idea that optimizing just one asset class, like bonds, in isolation isn't enough.
So building on that, maybe the whole industry's focus on finding the one killer app for tokenization, the perfect stablecoin, the ultimate collateral token. Maybe that's missing the point.
Interesting. You mean the real breakthrough isn't one amazing application?
But getting all the different applications to work together seamlessly. True interoperability. When tokenized bonds, funds, stocks, and cash can all interact instantly, frictionlessly across the whole system.
So the biggest gains only come from achieving those system-wide network effects, not just perfecting individual pieces.
Could be. Maybe the ultimate hurdle isn't just tech or regulation, but getting everyone, institutions, protocols, regulators to agree on standards and build that truly interconnected global infrastructure. Overcoming not just tech challenges, but maybe tribalism.
That's a fascinating angle. It shifts the focus from invention to integration and cooperation. Definitely something to ponder.
We really hope this deep dive has been useful, maybe educating, hopefully exciting, and definitely empowering you with some frameworks to think about this tokenization wave. If you've got insights from your own field, maybe you work in regulation or tech or finance, we'd love to hear your perspective.
Yeah, or if you have ideas for future topics you want us to tackle. Your input, your curiosity, that's what shapes the channel. Let us know.
We value you being part of this conversation.
Absolutely. Until next time, remember that understanding yourself, your own biases, is probably the best investment you can make in navigating these changing markets. Stay disciplined.
Invest wisely. We'll see you next time for the next deep dive.